Okay, I think we have a quorum and we can start. Assalamu alaikum, sabah al-khair, bonjour, good morning, and welcome everyone to this World Economic Outlook press briefing. I want to start by thanking the authorities and especially the people of Morocco for hosting us this week. I'm José Luis de Haro with the Communications Department here at the IMF, and as you know, we are here to introduce the latest edition of the World Economic Outlook. As you know, this new edition will include new numbers and projections for the global economy and our country members. Also, we'll take a look to the risks to our baseline and some policy recommendations. I would I hope that all of you had access to a copy of the report. If not, there are two ways you can access it. One is visiting imf.org. There you will find the report, but not only that, also Pierre-Olivier's blog and other assets like the data underlying charts and videos. And then my colleagues in the publishing department, they also printed out some brochures with QR codes that are all over the press room. And if you scan that QR code, you will be able to directly download the World Economic Outlook and all the other flagships that will be introduced during the week. We are here accompanied by Pierre-Olivier Gourinchas. He's the Economic Counselor and the Director of the Research Department. Next to him are Petya Koeva Brooks. She's the Deputy Director of the Research Department. And Daniel Leigh, he is Division Chief also at the Research Department. Pierre-Olivier is going to start with some opening remarks, and then we will proceed to take your questions. We will be taking questions also from reporters that are joining us online. And I want to remind everyone that we will have simultaneous interpretation. Without further ado, Pierre-Olivier, the floor is yours.
Thank you, Jose, and welcome everyone. Just weeks after a terrible earthquake that took a high toll in terms of human lives, Morocco is generously hosting our meetings. Allow me to express my sincere condolences and my gratitude to the Moroccan people. The global economy continues to recover from the pandemic and Russia's invasion of Ukraine, showing remarkable resilience, yet growth remains slow and uneven. The global economy is limping along, not sprinting. Under our baseline forecast, growth will slow from 3.5% last year to 3% this year and 2.9% next year, a 0.1 percentage point downgrade for 2024. This remains well below historical averages. Important divergences are appearing. The slowdown is more pronounced in advanced economies than in emerging markets and developing economies. Among advanced economies, the US has been revised up with resilient consumption and investment, while the euro area has been revised down as tighter monetary policy and the energy crisis took a toll. There is divergence also among emerging markets and developing economies, with China facing growing headwinds, while Brazil, India, and Russia are revised up. The news on inflation is encouraging, but we're not quite there yet. Headline inflation continues to decelerate. Core inflation, excluding food and energy prices, is also projected to decline, but more gradually. However, all in all, most countries are not expected to return to inflation target until 2025. Taken together, our projections are increasingly consistent with a soft landing scenario, bringing inflation down without a major downturn in activity. This is especially true in the US, where the unemployment rate is now expected to increase only mildly between now and 2025. Labor markets in advanced economies, while still tight, are softening without signs of a wage price spiral. Further, many countries are experiencing a sharp and welcome compression in the distribution of earnings, with wages growing faster at the bottom of the distribution. This could have to do with so-called amenity value of flexible and remote work schedules, reducing wage pressures for high earners. While some of the extreme risks have moderated since April, the balance remains tilted to the downside. First, the real estate crisis is deepening in China. Restoring confidence requires prompt action to restructure property developers, preserve financial stability, and address strained local public finances. The policy challenge is complex, but if well executed, it will enable China's economy to pivot away from a real estate credit-driven model of growth. Second, commodity prices could become more volatile with increasing climate and geopolitical shocks. This would represent a serious risk to the disinflation strategy. Between June and September, oil prices have increased by about 27% on the back of extended supply cuts from OPEC plus countries, before falling back more recently by about 8%. Food prices remain elevated and could be disrupted further by an escalation of the war in Ukraine. Geoeconomic fragmentation has also led to a sharp increase in the dispersion in commodity prices across regions, including critical minerals. This could pose serious macroeconomic risks going forward, including to the climate transition. Third, inflation remains uncomfortably high. Near-term inflation expectations have risen markedly above target. Bringing these expectations back down is critical to winning the battle against inflation. Fourth, fiscal buffers have eroded in many countries, with elevated debt levels, rising funding costs, slowing growth, and an increasing mismatch between the growing demands on the state and available fiscal resources. This leaves many countries more vulnerable to crisis. Finally, despite the tightening of monetary policy, financial conditions have eased in many countries. The danger here is that of a sharp repricing of risk, especially for emerging markets, that would appreciate further the US dollar, trigger capital outflows, and increase borrowing costs and debt distress. With still tight labor markets, ample excess savings in some countries, adverse oil price movements, and inflation expectations not fully normalized, central banks have more work to do to bring inflation back to target for a sustained period. They must avoid a premature easing. On the fiscal front, we must renew our focus on managing fiscal risks. Buffers need to be rebuilt, including by phasing out energy subsidies while still protecting the vulnerable. Fiscal and monetary policy pulled in the same direction last year, which helped the disinflation process. But this alignment has weakened. Most worrying is the case of the United States, where fiscal deficits have deteriorated substantially in 2023. Fiscal policy in the US should not be procyclical, even less so at this stage of the inflation cycle. We should also return our focus to the medium term. Here, the picture is becoming darker. Medium-term growth prospects have weakened since the global financial crisis, especially for emerging markets and developing economies. The implications for these countries are profound. A much slower convergence towards the living standards of advanced economies, reduced fiscal space, increased debt vulnerabilities and exposure to shocks, and diminished opportunities to overcome the scarring from the pandemic and the war. With lower growth, higher interest rates, and reduced fiscal space, structural reforms of the right kind at the right time become key. Higher long-term growth can be achieved through a careful sequence of reforms, especially those focused on governance, business regulations, and the external sector. These first-generation reforms help unlock growth and make subsequent reforms, whether to credit markets or labor markets, or for the green transition, much more effective. The weaker growth prospects also reflect the rising incidence of climate risk, with increased frequency of large natural disasters and rising geoeconomic fragmentation, such as the trade tensions leading to US-China decoupling. While some countries may benefit in the short term, in the medium term, all lose. Multilateral cooperation can help reverse some of these headwinds for the world economy. First, countries should avoid implementing policies that contravene World Trade Organization's rule and distort international trade. Second, countries should safeguard the flow of critical minerals as well as that of agricultural commodities. Such green corridors would help reduce volatility, food insecurity, and accelerate the green transition. All countries should aim to limit geo-economic fragmentation that prevents joint progress towards a shared global prosperity. A robust global financial safety net with a well-resourced IMF at its center is essential. Lastly, we are now back on the African continent for the first time in 50 years. I encourage you to join Abe Selassie and Jihad Hazur, the directors of our African and Middle East and Central Asia departments, at 6:30 p.m. today for the release of a special issue note on growth and resilience for the African continent. Thank you. Shukran.
Thank you, Pierre-Olivier. Before we start, some ground rules. Please, if you want to ask a question, raise your hand and wait till I call you. When I do, please identify yourself and the outlet that you represent. Try to be concise. As you can see, we have a full house here. We are also going to be taking questions from WebEx and our press center. And I just want to remind that Pierre-Olivier, Petya, and Daniel are here to talk about the global outlook, the projections for the countries, and the policy recommendations and risks. If you have specific questions about institutional issues and also about country programs, those can be tackled in the multiple press briefings from our regional heads, director heads that are going to happen during the week, and also from the press briefing from our managing director. So how I'm going to do this, I'm going to start through this side of the room, then I'll come to the middle, and then I will go to the right side. We're going to start here. The gentleman with the check, yeah, you. Wait. We cannot hear you, please. Can you?
I will try to speak loud. Okay. I'm Spas Nabowski from Bulgarian News Agency. Thank you for your presentation. I would like to ask you about the future locomotive of European growth. What do you think it will be?
Yes, so we have, I think I understood the question to be about the future engines of European growth. So let me start first by mentioning that we have, in terms of our projections for the euro area, we have this year a pretty sharp slowdown to 0.7% growth rate. That's a downward revision. This is one of the regions I've mentioned has been revised down in our projections by about 0.2 percentage point. And we're expecting a rebound in 2024, but it's a modest rebound. We're expecting a rebound to 1.2% growth in 2024. Now, when we look a little bit under the hood and we think about which economies are going to be growing strongly, what we're seeing is some continued weakness in for instance, Germany. Germany is expected to grow at only about 0.9% next year, while some other countries are growing a little bit more robustly. I think, for instance, Spain is expected to grow at 1.7% next year, while a country like France is expected to grow at 1.3%. So we get a little bit of heterogeneity in terms of growth engines for the European economies. I would say that in general, what we're seeing, the forces at play here, is that we have relatively weak momentum in manufacturing, so more manufacturing-oriented economies are suffering on the back of high energy prices. But we're also seeing a weakening of services. And so the services-oriented economies that had been doing relatively well in Europe are also seeing some slowdown going into 2024. So we're probably going to have a little bit of a soft patch, if you want, for European growth in the next year before it starts picking up after that.
Okay, we're going to continue on this side. I'm going to go with the lady in the third row.
Thank you. Good morning. My name is Nume Ekege from This Day newspaper, Nigeria. My question is on Sub-Saharan Africa. And could you give us the growth prospects for Sub-Saharan Africa, especially with Nigeria, more specific on Nigeria? And also the report speaks about the importance of job creation for SSA. Can you speak on how, or give advice on how Nigeria and SSA can enhance job creation? And also there's been the thing about energy subsidy. You mentioned it again in your report, and Nigeria recently phased out energy subsidies, brought it back in. What can you advise on how will be a sustainable and permanent way to phase out energy subsidies? And also if you can speak on the currency situation we have in Nigeria. Thank you.
Thank you. So on Sub-Saharan Africa, we have a slight downward revision for the region as a whole. I mean, we're expecting growth at about 3.3% this year, and that's a 0.2 percentage point downward revision. There's a slight downward revision also for next year to about 4%. On the details and the regional characteristics, let me turn it over to my colleague Daniel here.
Thank you. So for Sub-Saharan Africa, we have growth bottoming out in 2023, then coming back up in 2024. Inflation is peaking, but is still in double digits for more than 40% of the economies. We see African growth at 3.34%. That's above the global average, but it's below the potential that Africa has, and that it needs to catch up more quickly towards higher income levels. The shocks hitting growth are diverse, but there are several external ones coming from the higher fuel, food and fertilizer prices, still from the war in Ukraine, the funding squeeze, harder to get capital, and still very high spreads, therefore, for several economies, and exchange rate pressures. For Nigeria, in particular, we have a growth forecast that goes from 3.3% this year to 2.9% next year, before going up to 3.1% in 2024. There's a downward revision for this year. Partly this is because of the demonetization, the high inflation, the shocks to agriculture and hydrocarbon output. That's coming on top of those external headwinds. I would also add that President Tinubu has moved quickly with important reforms, including ending the fuel subsidies and unifying the official exchange rate. We welcome these initial bold reforms because we see them as paving the way towards stronger and inclusive growth.
Okay, we're going to continue. We're going to go just behind the lady that just spoke, to Larry Elliott, The Guardian.
Yeah, good morning. Larry Elliott of The Guardian. Two questions, if I may. The first is about the war between Israel and Hamas. How serious a risk do you think that is to the global economy? It obviously happened after the WEO went to bed. The second one is about the UK. Over the last year, you've revised up your forecast for the UK after being very gloomy. Is there a chance that you could have to do the same again, particularly if interest rates don't go to the 6% you are forecasting in the WEO? Thank you.
Well, thank you, Larry. So first, on the conflict in Israel and Gaza, well, we obviously are very saddened by the loss of life that we're witnessing, and we're monitoring very carefully the situation in terms of the economic impact it could have on the region and beyond. I think we have to be cautious. I think it's too early to really assess what the impact might be. And as you pointed out, of course, this happened after our round of current projections was closed. But we would have to wait a little bit before seeing what the impact might be. Of course, we all hope for a rapid de-escalation of the conflict and end to the violence. In terms of your question on the UK, so for the UK, we have a fairly sharp slowdown in 2023 compared to 2022, with growth coming down from 4.1% last year to 0.5% this year. That number is actually revised up a little bit compared to our July projections. And then continuing into 2024, growth remains fairly weak at 0.6%. So certainly relatively low growth performance that is projected. While inflation remains at fairly elevated levels, it's been coming down, and actually we've revised it down for the UK, but for 2023 we're still expecting about 7.7% headline inflation. That's been revised down slightly. So going forward, and let me also just address the point on the projections there. The assumptions that we used for our round of projections did include, when they were made in August, did include an expectation that the Bank of England would peak at about 6%. But our UK team, in finalizing their projections, used a number that incorporated some of the more recent developments and was closer to 5.5%. So that doesn't quite come up as high as the 6% we have there. The general perspectives here on the UK is, we have a fairly subdued growth. We have falling momentum. We have the labor market that is cooling, but inflation remains quite persistent, and that is going to require a monetary policy to remain tight for a little while longer into next year. I'll stop here.
Okay, we're going to start moving to the center of the room. I'm going to start here in the first row, the gentleman with the tie.
Good morning. Thank you for your presentation. I'm Zulfik Farzan from Sri Lanka, representing News First. My question is based on Sri Lanka, but I would appreciate if you would also give a global perspective as well on the region. Several countries are currently undergoing a debt restructuring process. And in the IMF World Economic Outlook, you had mentioned that the projections for countries, including Sri Lanka, have been excluded because of the negotiation processes going on. How long do you think that this process will take place for countries like Sri Lanka to achieve a certain degree of growth in the future while also meeting the creditor expectations? Thank you.
Thank you. Daniel, would you like to provide some views on Sri Lanka?
Thank you. So on Sri Lanka, the people of Sri Lanka have shown remarkable resilience in the face of enormous challenges. Sri Lanka has made commendable progress in implementing difficult but much needed reforms, and these reforms are already bearing fruit as the economy is showing tentative signs of stabilization. Inflation is down from a peak of about 70% a year ago in September 2022, down to below 2% in September 2023. Gross international reserves have increased, and shortages of essentials have eased. Now, despite early signs of this stabilization, full recovery is not yet assured. Growth momentum remains subdued, with real GDP in the second quarter contracting by 3.1% on a year-on-year basis, and high-frequency economic indicators continuing to provide mixed signals. So sustained reforms, continuing with these reforms, is going to be critical to put the economy on a path towards lasting recovery and stable and inclusive growth.
Okay, before we continue in the room, we're going to take a question from WebEx, from UK News. So if you can hear me, please unmute yourself and formulate your question.
Hi, and just a little more on the Middle East. Situation continues to intensify in the Middle East, notably between Israel and Palestine. Will it bring variables to the disinflation process, given what we see already in the sticky inflation in service sector and recent surge in commodity prices? And what does it mean for monetary policy? Thank you.
The sound wasn't really too great, so let me, I think the question was about the impact of the situation in the conflict between Israel and Gaza on the disinflation process and monetary policy. Did I get that right?
Yeah, exactly.
So what we can say there is, as I said earlier, we're monitoring closely the situation. One of the things that we have observed already is that oil prices have increased somewhat over the last few days by about 4%. And of course, this is something that we see often in situations where there is geopolitical instability in the region. We see spikes in energy prices and oil prices. We've seen that in previous crises and previous conflicts. And of course, this reflects the potential risk that there could be disruption either in production or transport of oil in the region. Now, as I said, it's a little bit too early to assess how much of that those movements in oil prices are going to be sustained. The work we've done in the research department at the fund suggests that if there is something like a 10% increase in oil prices, this would weigh down on global output by about 0.15% in the following year, and would increase global inflation by about 0.4 percentage point. So that gives you a rough order of magnitude of what the effect could be. But again, I emphasize that it's really too early to jump to any conclusion here.
Okay, we're going to continue with the gentleman with the light blue blazer.
Okay, yes. Thank you, Dr. Gourinchas and the IMF team. Eric Martin with Bloomberg News. I wanted to ask you about some news that came in even just in the last few minutes as you're speaking here about China considering a new stimulus package, and your outlook in terms of the measures that should be taken or appropriate from Chinese authorities in terms of supporting and boosting their economy, and whether it's possible for China ever again to regain the growth momentum that it had enjoyed in previous years. And also to ask about the economy, if I may, in Argentina, of course, the IMF's largest borrowing nation, and what you expect in terms of the economic outlook there. How concerned are you about the inflation impact of the recent stimulus measures announced by the government, and what to be looking for ahead in terms of the IMF's discussions and relationship with Argentina? Thank you.
Thank you, Martin. Let me say something about China, and then I'll turn it over to my colleague Petya for Argentina. On China, obviously this is one of the large economies that has been revised downwards in this round of projection. We are projecting growth of 5% in 2023. That's revised down by 0.2 percentage point. And we're also projecting that growth next year is going to be lower than expected before at 4.2%. That's revised down 0.3 percentage point. Looming large over this is, of course, the real estate crisis in China, where you have a number of pre-sold units that have not been completed. You have developers that are in financial difficulties. You have downward pressure on real estate markets, and there is a generalized lack of confidence in the household sector about what is going to happen in the real estate market. Clearly, what this calls for is forceful action by the authorities to help, for instance, restructure struggling property developers, to make sure that there isn't any increase in financial instability, make sure that this remains localized in the real estate market and doesn't spread out into the broader financial system, and help restore confidence of households that, in a sense, the real estate sector will be cleaned up, and prices will be eventually allowed to adjust down. So that requires forceful action on the part of the authorities, and we've seen some measures that have been taken in recent weeks. You mentioned something during the press conference. I haven't checked my phone, so I don't exactly know what it is. And these measures are welcome, but they need to be be at scale, and so certainly the problem is serious and needs to be tackled appropriately. Monetary policy can certainly help as well. There is a sense in which monetary policy can be eased. China is in a very different place than the rest of the world in terms of the inflation pressures. If anything, their inflation numbers are below target, so they have room to ease monetary policy, and they have room to support on the fiscal side, support the housing, the household sector by redeploying some of the fiscal measures and helping households and consumers. So these are sort of the measures we would encourage the authorities to undertake, and I think they're moving in that direction, and this is to be welcome. On Argentina.
So on Argentina, our forecasts are unchanged for growth since July, and what they imply is a contraction of output of this year of 2.5%, followed by a resumption of growth of 2.8% in 2024. Now, the contraction this year is very much because of the drought which we had observed, and then the rebound is also because of the normalization of agricultural production, which is expected in 2024. At the same time, there's a lot of uncertainty around the forecasts, especially in 2024, as imbalances are building. And speaking of that, our inflation forecast for this year has been increased to over 135% year end. And this was because of the higher than expected impact of the exchange rate realignment in August, as well as some of the policy slippages that we had observed. And all of this calls for policy response, for tighter fiscal policy supported by also tight monetary policy to address some of these imbalances. Thank you.
Okay, we're going to continue in the room. We're going to go to the lady back.
Hi, good morning, everyone. Silvia Berzoni, Class CNBC. In July, you revised upwards Italian GDP estimates, which are now cut to 0.7% both for 2023 and 2024. I wanted to ask what has changed and what is waiting on growth. And the second question will be on the inflation outlook. We will go from 6% to 2.4% in 2024. So what is driving such a sharp disinflationary path? Thank you very much.
Yes, so on Italy, and I will start, but then I will hand it over to my colleague Petya as well. I mean, I think it's one of those economies where we're seeing, on the one hand, there has been some positive impulse that's coming from the National Resilience and Recovery Plan, for instance, the EU funds that have been deployed in the last few years. But on the other hand, we're seeing also a weakening momentum. We see that construction has become weak and manufacturing also. And this is in the context that I've already mentioned, where services sector is also weakening, and we're seeing that in Italy as well. But Petya, any additional details?
Sure. So we are expecting growth this year to be 0.7 and then also 0.7 in 2024. We have revised down the growth rates for both this year and next. What's behind us is, although we had a strong Q1 of 2023, then we observed contraction in the second quarter of this year. And what was behind us was a relatively weak domestic demand, as some of the incentives on home renovations had expired. And we also observed a collapse in investment in construction investment. At the same time, we also saw a weaker trade environment, which contributed to this downgrade. Now, when it comes to inflation, we are expecting inflation to come down in a way that is similar to what we're also expecting in other countries. Part of that, the decline in headline inflation, is related to the unwinding of the increases in energy prices, and of course the tighter monetary monetary policy, the tighter financing conditions are also expected to contribute to this decline in inflation in Italy as well as the rest of the Eurozone.
Okay, we're going to move to the right side. We're going to start here in the front row. Excuse me, please, respect your order. I will go back to that side if there's time, but I'm trying to manage the room, okay? So please be patient and respect your colleagues. Please go ahead.
Thank you. Raman Yang from Bloomberg. Two questions, if I may, very quickly. China's slowdown is a big theme within the report, and one of the things that we also noticed in it is that you're pointing to a 10 basis point decline in exports as well from emerging economies. Could you give us a sense of how big an effect China's slowdown is having on economies, particularly in sub-Saharan Africa, your big resource exporters, Angola, Nigeria, South Africa, and so on? And secondly, you also argue that monetary policy needs to remain tighter for longer. But for a lot of SSA economies, the key drivers of inflation tend to be, higher food prices, higher energy prices, things that really monetary policy cannot touch. So in that sense, isn't that advice in some way a bit like, trying to get a sledgehammer to kill a mosquito?
Okay, so let me address your question. So first, yes, of course, the slowdown in China is a big part of the story, and it is true that whenever Chinese economy slows down or experiences something like what we're seeing this year, this has spillovers to the rest of the world. Our estimates are that typically, if there is 1 percentage point lower growth in China, this translates into something like 0.3 percentage point lower growth in the rest of the world. Now, it's not uniform in the rest of the world. Of course, it's going to be mediated in part through the trade channels, and so trading partners, close trading partners of China, whether they are in a region or elsewhere, and some of them could be in Africa, will be more affected than more distant trading partners. But overall, it will of course weigh down on China and the rest of the world. We actually in the WEO report we look at a risk scenario where the slowdown in China could be larger than what we have in our baseline. In the baseline, we're revising down growth this year and next. But because we have some concerns about the extent and how the real estate crisis might develop, we also look at a risk scenario where this becomes larger. And in that risk scenario, growth in China would be coming down by an additional 1.6, or the output level would be down by 1.6% in China. And that would also translate in about 0.6% lower output in the rest of the world. So along the same orders of magnitude I mentioned. And so that, of course, would have implications elsewhere. On monetary policy and energy prices, you're absolutely right. A number of regions in the world have seen a huge increase, in particular in the headline part of the price index, coming from the energy and for some countries, food prices as well. Now, does that mean that there is no role for monetary policy? And the answer is no. Why? Well, because these shocks to headline inflation tend to feed into broader measures of inflation. They first hit your energy bill, but then energy bills is, part of the production costs for businesses. It's part of the living expenses for workers. So then it leads to higher demand for wages. It leads to higher prices for businesses. Then it gets into underlying measures of inflation. And what is really important for monetary policy is to make sure that the underlying measures of inflation are going to be coming down. And if this is not contained, then it gets into measures of expectations of inflation. You see inflation high for a while, then you come to expect inflation to be high for a while, and then it becomes almost self-sustaining. So monetary policy has a role to play in order to make sure that both inflation expectations and underlying measures of inflation are contained, even if the source of the shock, as you rightly pointed out, could be on the energy side. And this is why our recommendation for monetary central banks around the world in the face of a fairly persistent energy price shock is that they needed to tighten monetary policy. And this is showing its effects already in the world economy. It's been cooling off global output for sure, but it's also showing signs that it's helping in bringing down inflation, bringing it back down to central bank targets.
Okay, we're running out of time, but we will have time for two more questions. I'm going to go with the lady with the white shirt.
Thank you, Jose. This is Deepshika from Economic Times India. Two questions. In your India assessment, you have raised the growth projection for India and also raised the inflation projection. In the backdrop of what's happening to oil, hardening of the US interest rates and appreciation in dollar, what is your assessment going forward for India? What kind of an impact could it have? And also, in line with the inflation projection, do you see room for further interest rate tightening by monetary policy authorities?
Thank you. So on India, we have, it's actually India is one of the countries, one of the large emerging economies that has been doing better than expected. It's been doing better for a while now, and we've mentioned that India is in fact one of the growth engines in the world economy at this point. And we're revising growth for the fiscal year to 6.3%. That's a 0.2 percentage point upward revision for this year. We're not changing our projections for next fiscal year. They remain at 6.3%, but that's a robust growth number, although it's still a slowdown, a little bit of a slowdown from last year. And you're right that inflation is also pushing up in India. We have an upward revision for inflation to 5.5%. And some of this is related to increased food prices in the country. Daniel, anything to add on India?
I'll just add that we do expect for India inflation to come down to 5.5%, to be well inside that target range of 2 to 6% this year, and 4.6% next year, so well inside the band. That is conditional, though, on the monetary policy continuing to be very focused on delivering price stability and while preserving financial stability. Continuing to be a data-dependent approach is what is needed. What would also support this effort is more fiscal consolidation, especially in terms of a medium-term plan to reduce debt. That would also support the monetary policy in reducing inflation.
Okay, we're going to go back to this side of the room. We're going to go with the gentleman with the pen in his hand.
Merci, bonjour.
Thank you. Mira Kabej from Morocco Hebdo. What are your projections for the Moroccan economy? What is the IMF interested in? Only macroeconomic indicators like headline and core inflation. For core inflation in Morocco, the basket has nothing to do with real prices that are skyrocketing. Is the IMF only interested in macroeconomic indicators that do not create jobs? Are the IMF growth, does the IMF not care that its projections do not bear any link with the reality?
I will answer in English. So first, the question was about the kind of macroeconomic variables we look at, and in the context of Morocco, the weight we put on food prices versus underlying measures of inflation, and how we weigh this in our projections. And I think we certainly very concerned about rising food insecurity globally. We've seen a sharp increase in food insecurity. We've seen that a much larger number of people in the world are in situations where the access to required caloric intake is not necessarily guaranteed in the wake of a sharp increase in food prices. And we've seen also that increase in food prices tends to hit more parts of the world where people are already more food insecure. So it's really creating a lot of hardship. So we do pay a lot of attention to that, and we're certainly concerned about some of this, which is why, for instance, we're calling for countries not to impose restrictions on food exports. Because that, while this may be beneficial in their own country in a narrow sense, it can also create and exacerbate food insecurity more broadly, and in a way that would not be welfare enhancing. On the specifics of Morocco, there was a little bit of a discussion on the side here. I'm not exactly sure who is taking the question. Daniel is taking the question. Thank you.
Ok, merci. Moi aussi, je vais répondre en anglais.
Thank you. I'm going to answer in English.
That is going up in 2023. We've got 1.3% in 2022, then 2023 is going up to 2.4%, because there was actually a very strong first half of the year before the earthquake. In the agricultural sector, despite the drought, but there was some normalization, and very strong tourism. So overall, still 2.4% growth for this year, rising to 3.6% next year. A lot of this will also be supported by the reconstruction efforts. It's heartening to see the voluntary contributions, 1% of GDP, are going to be helping to finance this effort. And inflation in Morocco we see coming down towards 4% by the end of this year. Thank you.
Okay, I'm afraid that we don't have more time, but in behalf of Pierre-Olivier, Petya and Daniel and the Communications Department, I want to thank you all for attending. Don't worry, there's going to be plenty of press briefings where you're going to be able to ask your questions. I hope that you have a good rest of your day. Shukran, thank you very much.